The live price of Opendoor Technologies Inc., Open, is 5.51, reflecting a significant intraday movement of over 7.44% in a single session. This kind of volatility is becoming the new normal for Opendoor, and it's a stark reminder that while the company is grappling with a deep, systemic business model transformation, the market is still treating it with the wild-eyed fervor of a meme stock. The common expectation, especially among retail investors who have driven much of this recent surge, is that Opendoor's rebound is a direct consequence of a housing market bottoming out and the company's newfound operational efficiency. However, a deeper look reveals that the narrative of a simple housing market recovery is a dramatic oversimplification. The real story is far more complex, a tension between genuine strategic shifts and speculative froth. The company's recent Q2 2025 financial results showed revenue of $1.6 billion and a net loss of just $29 million, a considerable improvement from the previous year. What the market is reacting to, and what investors might be missing, is the company's strategic pivot away from its original, capital-intensive iBuying model. This is not just a tweak. It's a fundamental change in how Opendoor operates, and the market's current enthusiasm may be underestimating the long-term execution risk involved. The dramatic daily swings in Opendoor's stock, with volumes in the hundreds of millions, are not just about a fundamental belief in the real estate sector. They are also a clear indicator of the powerful influence of institutional flows and, more notably, retail speculation. For example, recent institutional filings show a mixed bag of activity. While some large institutions like Cube Research, Technologies, and Two Sigma Advisors have added shares, a number of major holders, including BlackRock and Vanguard, have significantly reduced their positions in the last quarter. This divergence paints a picture of a stock that is deeply polarized. On one side, quantitative funds and short-term traders are capitalizing on the volatility, while long-term institutional investors appear to be de-risking their portfolios, signaling a lack of conviction in the company's core business model. The heavy insider selling 14 sales to only 2 purchases in the last 6 months further complicates this narrative. When the very people who know the company best are cashing out, it raises a significant red flag that is often overlooked by the excitement of a momentum trade. This is the core tension: the retail expectation of a home run recovery versus the institutional reality of a company in a state of flux. The stock's journey from a 52-week low of around 0.51 to its current price near the 5.5 mark is a testament to this, showing a parabolic move fueled by a mix of genuine business improvements and pure momentum. Opendoor's core business, as it was originally conceived, was to be a direct-to-consumer iBuyer. The company would use its proprietary technology to make instant, all-cash offers on homes, buying them, making minor repairs, and then reselling them for a profit. The promise was to bring simplicity and certainty to a notoriously complex and stressful process. This model performed exceptionally well during the pandemic-era housing boom, but it faltered spectacularly as interest rates rose, home sales slowed, and the company found itself sitting on a massive, depreciating inventory of homes. The shift, which is now well underway, is towards an asset-light, agent-led platform. Opendoor is now less of a direct home flipper and more of a technology platform for real estate professionals. It's working to integrate its technology into the workflows of traditional real estate agents, offering a suite of solutions that complement its original cash offer model. The new strategy involves partnerships with agent networks, allowing them to provide clients with a variety of options, including an instant offer, a listing on the open market, or a combination of both. This pivot is designed to reduce the company's capital requirements and mitigate the immense balance sheet risk that nearly sank the company in the last downturn. The company's recent earnings, which showed a significant reduction in losses and a move toward adjusted EBITDA profitability, are largely a result of this de-risking strategy. However, the path to a sustainable, profitable business under this new model is long and filled with challenges. The company is essentially trying to transform from a disruptive force into a supportive partner for the very industry it once aimed to disrupt. Looking forward, the future of Opendoor stock is a high-stakes bet on execution. The market is pricing in a best-case scenario where the new, capital-light model not only works, but also generates consistent, high-margin revenue streams from services like mortgages, title, and insurance. The optimism is that by serving a wider range of customers and leveraging its data and technology, Opendoor can become a central hub for all things real estate. This would be a remarkable transformation from its previous state. The catalysts for this vision include a successful and rapid rollout of its agent-led platform, which could dramatically increase its market reach without the associated capital risk. Another potential tailwind is any legislative or macroeconomic action that makes the housing market more liquid and stable, though this is largely out of the company's control. However, the risks are substantial. The real estate market remains highly sensitive to interest rate fluctuations, and any further tightening could put renewed pressure on home sales and, by extension, Opendoor's ability to generate transaction-based revenue. The competition from both traditional brokerages and other tech-enabled platforms is fierce, and Opendoor must prove that its technology is truly a differentiating factor. The biggest risk of all is the possibility that the new model, while safer, simply lacks the scale to generate the kind of revenue and profitability required to justify its current market capitalization. The company's journey from a high-flying disruptor to a struggling survivor and now a potential platform play is a compelling narrative, but it's far from a guaranteed success story. The valuation today reflects the potential for greatness, but the reality is that the company is still in the early stages of a risky and unproven transition. The fundamental expectation about Opendoor is that it is the ultimate leveraged play on a recovering housing market. The belief is simple. When home prices go up, Opendoor's inventory becomes more valuable, and its business model automatically becomes profitable. This is the expectation that has driven the stock's astronomical rise from its lows. But the reality is that Opendoor's profitability is not just about home prices. It's about the company's ability to accurately price homes, manage its operational costs, and generate new, higher-margin revenue streams from its evolving business model. The most recent earnings report, with its improved financial health, was driven by a drastic reduction in home purchases, which lowered risk but also dramatically reduced revenue. This is a subtle but critical point that the market often misses. The company is getting healthier not by thriving in a good market, but by hunkering down and de-risking in a tough one. The challenge now is to show it can successfully scale the new model without regressing to its old, capital-intensive ways. This tension between the simple, bullish narrative and the complex operational reality is what makes Opendoor one of the most fascinating and dangerous stocks to watch. The simple narrative suggests a surefire winner, while the nuanced reality points to a high-risk, high-reward turnaround story still in its infancy. Do you think Opendoor can truly become a capital-light real estate platform? Or will it remain a cyclical play on the housing market? Comment below with your thoughts. The long-term success of the company depends on whether it can defy its past and prove that its future is about more than just a home price index.